Warren Buffett has calculated your net worth, and it's at least $500,000. He's also identified the single instrument destroying that value faster than any market crash in history. It charges you 18 to 20% annually, and you probably used it this week. That is not a metaphor. It is a valuation. Buffett applies the same rigorous methodology he uses to price businesses, discounted cash flow analysis, and he applies it directly to you. Before we go further, this channel exists to build long-term financial clarity, not to sell shortcuts. If that mission matters to you, subscribing is a form of personal commitment to the work, not to an algorithm. Share your core investment philosophy in the comments. The strongest thinking in this community sharpens everyone's edge. And as always, everything discussed here is for educational purposes only, not personalized financial advice.
In 1999, at an education forum in Nebraska, Buffett posed a question to a room full of students. He called it a thought experiment. It was, in fact, a valuation exercise. He asked, if I offered to buy 10% of your financial future, writing you a check today in exchange for 10% of everything you earn for the rest of your life, what would you charge me? Sit with that question. A focused, disciplined professional in a developed economy will earn substantial income across a 40 to 50-year career. 10% of that figure is not trivial. It is a number that demands respect. Buffett's conclusion is precise. Every young person entering the workforce represents a minimum $500,000 asset. The methodology is strict corporate finance, future cash flows, adjusted for inflation, discounted to present value. This is not optimism. This is arithmetic. And arithmetic does not care about your feelings about money.
Buffett himself is the most instructive example of what early capitalization of skills actually produces. Between 1957 and 1969, running Buffett Partnership Ltd., he compounded capital at 29.5% annually. Over that same period, the Dow Jones Industrial Average returned 7.4% per year. Buffett did not beat the market. He rendered the comparison nearly irrelevant. His cumulative return over those 12 years reached 2,794.9%. By 1962, through disciplined analysis, not inheritance, not speculation, he was a millionaire. He had built a personal economic moat, a set of skills so rare, so self-reinforcing, that the market had no choice but to reward them decade after decade. There is an instrument, widely available, heavily marketed, socially normalized, that operates as a direct short position against that same $500,000 asset. It does not require bad luck. It does not require a market crash.
It is mathematically guaranteed to transfer your future wealth to a financial institution. In investment terms, a short position is a bet against an asset. You borrow it, sell it, and hope it falls in value. Consumer credit works the same way against your own future. You borrow against your earning power and pay a premium every single month for the privilege of doing so. That instrument is revolving credit card debt. Rates in the United States routinely reach 18 to 20% annually. Buffett has been unambiguous about this for decades. At Notre Dame in 1991, he said, "I've seen more people fail because of liquor and leverage being borrowed money. You really don't need leverage in this world. If you're smart, you're going to make a lot of money without borrowing." The mathematics are not subtle. The U.S. stock market, across the last half-century, has returned an average of 8 to 11% annually, with significant volatility.
Credit card debt costs 18 to 20% annually, with significant volatility. Consider the arithmetic directly. You have $1,000. You invest it in a broad index fund, expecting a 10% return. You earn $100. Simultaneously, you carry $1,000 in credit card debt at 18%. You owe $180 in interest. Your net position? A loss of $80, despite a successful investment. Paying off a credit card balance is the equivalent of earning an 18 to 20% after-tax risk-free return. No hedge fund manager on earth offers that reliably. No real estate asset, no stock portfolio, nothing. At the 2020 Berkshire Hathaway annual meeting, held in an empty arena in Omaha, broadcast to shareholders around the world, Buffett made this concrete. A woman had come into a modest sum of money and asked him where to invest it. He did not discuss equities.
He asked one question. How much do you owe on your credit card? When she confirmed the rate was around 18%, his answer required no deliberation. I don't know how to make 18%. The first thing I do with any money I have is pay off the debt. It will be better than any investment idea I have. You are not a consumer who occasionally invests. You are a $500,000 asset, and every dollar of high-interest consumer debt is a guaranteed mechanism of degradation. The short position is open the moment you carry a balance. The compounding works in reverse, and it does not sleep. The destruction is clear in the United States at 18 to 20%. But what happens when the same mechanism operates in an economy where wages are a fraction of American levels, and the rates are not 20%, but 44 or 51? The mathematics of debt does not change with geography. Only the speed of the damage does. That number exists.
And it is the reality millions of people are living inside right now. Here is a question every investor asks before writing a check. What is the return on this investment? Not the hope, not the story, the actual compounded mathematical return over time. Now ask that question about yourself, about the money you are spending on education, about the years you are trading for a degree. What is the real return on that investment? The data has an answer. A bachelor's degree adds, on average, $900,000 to a man's lifetime earnings. For a woman, that figure is $630,000. These are not projections. They are measured outcomes from careers already lived. Run those numbers through a standard discounted cash flow model, the same tool used to value companies, at a 4% discount rate. The net present value of a bachelor's degree is $260,000 for men.
$180,000 for women. Today, in your pocket, right now, if you could sell it. Go one level higher. A master's degree or a PhD adds up to $1.5 million in lifetime earnings for men, over $1 million for women. A professional degree, law, medicine, finance, can generate a lifetime return on investment of up to 2,249% over a 40-year career. 2,249%. Buffett's own partnership, one of the greatest investment records in human history, produced 29.5% per year for 12 years. A professional degree, measured correctly, beats that. Not in annual terms, but in total, absolute, compounded human output. So why does this not feel like wealth? Why do so many educated people feel financially behind? Because of the J-curve. And the J-curve is brutal. In the first 10 years after entering the workforce, the return on a bachelor's degree is negative 16.54%. You have paid tuition, you have lost income during study, and you are now earning entry-level wages, while your debt, if you carry it, is compounding against you every single month. The break-even point arrives at roughly 12 years into your career. 12 years before the investment simply pays back what it cost.
The gains come after that, all of them. But you have to survive the J-curve to collect. This is where consumer debt becomes a surgical weapon aimed at your future. You are in the negative phase of the curve. Your returns are still years away, and you are carrying a credit card charging you 18 to 20% per year. You are bleeding from both ends simultaneously. A worker with a bachelor's degree earns an average of $36.84 per hour.
An advanced degree holder earns $49.48. That $12 gap per hour is the premium the market pays for the additional investment in yourself. But if 20% annual interest is consuming that premium before it compounds, the gain disappears before you ever touch it. You are running in place on a treadmill set to an incline you cannot see. Warren Buffett understood this at a structural level. He did not frame education as a credential. He framed it as a moat, a defensive perimeter around your earning power that competitors cannot easily cross. Buffett said it plainly: inflation cannot take away your skills. A government can devalue a currency overnight. A market can crash a portfolio in a week. But no external force can reach inside your mind and remove what you have learned. That is the only asset class with absolute seizure protection. The personal moat is built at the intersection of disciplines. It is not one skill. Anyone can acquire one skill. The moat is the combination, the rare overlap of competencies that creates something the market cannot easily replicate. What comes easily to you, but is difficult for others? That intersection is where your economic moat begins. An hour a day. That is the minimum investment Buffett recommends in self-education. Not a weekend course, not a quarterly seminar. One deliberate hour, every day, directed at building the rare skill set that sits at your specific intersection. Compounded over a decade, that is 3,600 hours. More than enough to reach professional mastery in any field. But that hour only compounds if the debt is not compounding faster. In certain markets operating right now, credit card rates reach levels that no skill acquisition rate in history has beaten in the short term. You cannot outrun those numbers. No one can. Kill the debt first, then compound the skill. In that order.
Reverse it, and the math works against you at every step. The educated person carrying consumer debt is not building wealth. They are funding someone else's compounding. Every month the balance persists, the bank collects what the degree was supposed to produce. The moat fills in. The advantage disappears. This content is for educational purposes only. It is not individual financial or career advice. The data presented reflects historical outcomes and macroeconomic research. Your specific situation requires your own judgment and, where appropriate, qualified professional guidance. A degree is among the highest returning investments a human being can make, but it must be held debt-free and pursued with discipline to pay what the data promises. There is a silent tax that can erase every dollar of that return. And in some markets, it does not operate at 18%. It operates at rates that would bankrupt a hedge fund. What does that rate look like where you live?
Here is the number no one in Ukrainian finance wants to say out loud. The real annual interest rate on a monobank credit card, 44.37%. Privat bank, 51.09%. These are not payday lender rates. These are the rates offered by two of the most widely used consumer banks in the country. Now hold that number against the average Ukrainian salary in Q1 2026. 28,885 hryvnias per month. That is the median, the center of gravity. The number that describes the financial reality of most working people in this country. Run the arithmetic.
A person earning that median salary, who carries a balance on a Privat Bank credit card, is paying more than half their potential annual earnings growth in interest alone. This is not a financial inconvenience. This is a mathematical emergency. And the market is moving in the wrong direction. Ukraine's retail credit portfolio grew 34% year over year in 2025. It has doubled since the lows of 2022. More people, more debt, higher rates.
The compounding is working, but it is working against the borrower. Here is what makes this particularly dangerous. The people most exposed to this trap are also the people with the least margin for error. Women in Ukraine earn 27% less than men on average. 24,798 hryvnias per month versus 33,798 for men. The gap is widest in the fields with the highest long-term earning potential. In arts and culture, the gender wage gap reaches 47.1%. In finance, 38.7%. In information technology, 37.8%. The sectors where skills compound fastest are the same sectors where the wage floor for women is lowest. That means the J-curve, the decade of negative ROI after investing in education, cuts deeper and lasts longer. Consumer debt at 51% does not bridge that gap. It widens one. Every month a person carries that balance while waiting for their education investment to mature, they are being charged compound interest on their own future.
Warren Buffett said it plainly. He does not know how to make 18%. He was talking about the United States. In Ukraine, the question is whether anyone, any business, any fund, any professional, consistently earns 51% annually. The answer is almost universally no, which means the borrower is financing a guaranteed loss. This is the credit trap in its purest form. It is not a moral failing. It is not laziness. It is a structural mechanism that extracts wealth from people before they have had the chance to build it. Recognizing it is the first act of financial self-defense. A doctor who diagnoses a disease correctly but prescribes the wrong treatment has still failed the patient. The same logic applies here. You can eliminate the debt, you can compound the skill, you can build the moat, and still destroy everything if one variable is missing. That variable is the one Buffett has called the first filter for every person he has ever hired. Integrity, not intelligence.
And still destroy everything if one variable is missing. That variable is the one Buffett has called the first filter for every person he has ever hired. Integrity, not intelligence, not energy. Integrity first. Because without it, the other two do not cancel each other out. They accelerate the damage. In 1993, Buffett spoke at Columbia Business School. He told the students he looked for three things in people: integrity, intelligence, and energy. Then he added the line that changes everything. If they don't have the first, the other two will kill you. Read that again slowly. Intelligence without integrity is not neutral. It is destructive. Energy without integrity does not dilute the damage. It accelerates it.
They run straight into a wall.
Buffett has also said this: it takes 20 years to build a reputation and 5 minutes to destroy it. Think about that in the context of education ROI. A professional degree takes years to acquire. Its full earnings premium compounds over a 40-year career. The return is enormous, but it is also fragile. One serious breach of trust can liquidate decades of compounding
overnight. This is why the personal moat, the rare compounding intersection of your skills, must be built on integrity first. A moat filled with water holds. A moat filled with sand collapses under its own weight. Skills without character are a moat made of sand. So where does this leave you, practically? 3 obligations. Not suggestions, obligations. If you accept the premise that you are a capital asset worth protecting. The first obligation: eliminate consumer debt. Not reduce it, eliminate it.
Every percentage point of credit card interest is a direct levy on your future earnings. In the Ukrainian context, at rates above 44%, this is not a slow leak. It is a structural hemorrhage. Treat it as the emergency it is. The second obligation: invest in the skill that sits at your personal intersection, the capability that comes naturally to you but is rare in the people around you. That is your moat. Deepen it. Cross it with a second discipline. Make it genuinely difficult to replicate. That compounding is inflation-proof, recession-resistant, and entirely yours. The third obligation: guard your integrity as you would guard a balance sheet, because it functions exactly like one. Every decision you make either adds to the trust equity you have built or subtracts from it. And unlike a
This content is for educational purposes only and does not constitute financial advice. Every individual's financial situation is different. Before making any significant financial decisions, consult with a qualified financial professional. The data presented here reflects research available as of mid-2026, and market conditions change. The moat is built in 3 moves. Kill the debt, compound the skill, never compromise the integrity. Everything else is noise.